And it's 10 a.m. right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams. First off, let's take a look at what's happening in markets. U.S. oil climbed to the highest level in more than a decade. Wednesday's trade with global benchmark Brent topping $111 per barrel as crude's blistering rally continues. The advance comes as OPEC and its oil-producing allies, which include Russia, prepared to meet Wednesday to discuss, that is today, to discuss April's output. West Texas Intermediate crude futures, the U.S. oil benchmark jumped 6% to trade at $109.67 per barrel, after earlier soaring as high as $110.18 per barrel, its highest since April 2011. According to data from Refinitiv Icon, during regular trading Tuesday, the contract gained 8% to settle at $103.41 per barrel. Global benchmark Brent crude rose 6% to trade at $111.36 per barrel. Brent had briefly climbed as high as $111.78 per barrel earlier, a level not seen since January 2013. According to data, this is showing that the contracts rose 7.15% to settle $104.97 per barrel. And mobile transactions in Nigeria hit 8.07 trillion naira within 5 years, as the number of telecommunication subscribers rose by 34.91% to 195.12 million as at the end of 2021. According to latest report from the Nigeria Interbank Settlement System and Nigerian Communications Commission, the figure, which represents an increase of more than 4,000% from 169.29 billion naira recorded in 2017. Further analysis of the NIBSS report indicates that the volume of mobile transactions surged to 284.5 million in 2021. This is attributed to this increase in mobile channel to changing behavior of bank customers as a result of the COVID-19 pandemic. And after the break, we'll take a look at economic implications for Russia's war in Ukraine on emerging economies in Nigeria. That's in a moment. Just stay with us. All right, now to our first conversations. See, tensions over the Ukraine-Russia crisis have been simmering for more than 2 months, with diplomatic efforts to resolve the issue showing little sign of progress, even with mounting global pressure. Let's discuss possible impact on emerging economies with Moshope Aruba, Economists, IC Group, joining us on Business Morning. Great to have you. Good morning.
Good morning, Ladi. Great to join you.
Yeah, so, there are concerns that, with Russia being a global power, it could cause, major dislocations across the world with more riveting implications for susceptible economies like Nigeria. What are your thoughts on that?
That's correct for most countries. The impact of the conflict on countries that do not have strategic interest in the ongoing conflict, for instance, African countries, is largely going to be economic. Russia is a commodities powerhouse and is a price maker in a number of commodities markets, including in hydrocarbons. Ukraine also plays an important role in the grains value chain, so the conflict will trigger commodity price increases across both markets. The higher commodity prices will manifest in African economies through higher inflation, weaker current and fiscal balances, and possibly a squeeze on economic growth if monetary action moves in tandem with inflationary pressure. Nigeria, for instance, exports crude oil and imports refined petroleum. We also have an unsustainable subsidy bill and are still largely import dependent for majority of our consumables. So we're likely to feel the price shock on multiple fronts. Higher crude oil prices are obviously positive for our export earnings, but also impact the landing cost of petroleum and invariably the subsidy bill. So fiscal balances will be under pressure. Higher pricing for food items in the global markets will also increase the food import bill for many African countries.
Right.
And along with higher prices at the pump for countries without fuel subsidies, will filter into consumer price. So pretty much African consumers need to brace up for more purse pinching over the next few
Yeah,
weeks.
time to brace up. And, but before now, it was talk about inflation, being, transitory in global economies, but, that changed.
Yeah.
And, but now there's another word being thrown around, and that's stagflation. How's that looking?
Pretty much that's a major concern. That's a major economic concern because with higher inflationary pressure, you're likely to get more tightening from monetary authorities, and with tightening comes less liquidity in the market. Cost of fund becomes more expensive. People are not able to take loans to support their businesses. Businesses that are still trying to recover from the pandemic heat that they experienced in 2020 and to some extent in 2021. So if inflationary pressures are going to be pushed higher, especially by this Russia-Ukrainian crisis, then we're likely to see more tightening. So if you probably were expecting 1 or 2 rate hikes, you should be expecting a lot more. If any country that has like a more responsive central bank will probably be pricing in more rate hikes at this time, and that is not growth positive.
Right.
So we may find ourselves in a situation whereby growth is undermined just to rein in inflation.
All right, and let me take you back to oil now. We see prices are, surging, and obviously Nigeria is not, benefiting, from this. But I hear the government is vowing that we're going to ramp up production, to meet up with our quota. How realistic is that for you?
We've always been planning to ramp up production for so many years, but the truth is a lot of our challenges are more structural rather than market driven. So we have a number of reasons: policy inconsistency, lack of political will to drive market-friendly reforms, and a number of other legacy issues that is stifling like inflow of investment into the oil sector. Especially look at how long it took to get the Petroleum Industry Act, and even after signing the act, the government is obviously reneging on the subsidy removal clause. So we may have the capacity to increase our output, we may have the intention to, but if fresh investment is not coming in to maintain existing oil infrastructure, explore new wells, our crude oil is likely going to continue to dwindle, just as it happened with Angola.
Right. And, another thing that's been on the decline is our foreign reserves, our external buffers. It's been trending downward. With all of this happening, what can we expect there?
So for the external reserves, yes, we have like oil trading at about 111 as at this morning. But the thing is, the accretion to reserves isn't just oil receipts. You also have inflow from remittances. You also have investment flows, which should ordinarily accrue to the external reserves. Unfortunately, we all know what's going on with remittances, to the extent that the CBN has this like Naira for dollars scheme in place just to try and encourage people to come through the official channels of remittances. We also know what's going on with investment flows. There's been a drought of FDI into the country. And even FPIs now are having like a hard time trying to repatriate their funds, and the chances of them coming back when they successfully do that is probably quite slim. So with the amount of pressure we have on the demand front for FX, and probably just only one source of inflow into the reserves from oil receipts, we're still.
Hello, Mashokwe. Looks like Mashokwe is frozen there. Mashokwe, I don't know if you can still hear me. Are you there? Okay. All right. Seems we're having a glitch there with the connection there. Well, I was going to talk about most of this Ukraine-Russia crisis. If it prolongs, what happens? Most people don't expect it to stay that long, but I will try and get Moshope on later to see how we can round up the conversation But to then we'll just take a quick break. When we come back, we'll continue the conversation. That's in a moment. Just stay with us. All right, we're back now. We're still having the conversation with Moshope Arubai, economist, right there. Moshope, we lost you the other time. I think we have you now. Welcome back. Well, I was saying, you know, most people don't expect this war to, you know, continue very long. But take, for instance, you know, it prolongs, it gets even longer. How can, you know, emerging economies, what can we do, you know, to protect our economies at this point?
Really, there's nothing much emerging markets can do. I know that there'll be a lot of pressure on the currencies, so central banks can choose to step up to the plate and defend their currencies, sell more FX into their at their auctions, pretty much. But in terms of the markets, I mean, I feel the wind would blow off eventually. Russia is not new to aggression. Is also not new to being a catalyst for market turbulence. I know once the conflict started, we felt the heat in a number of risky assets. Some have recovered, some are yet to, and there were also some beneficiaries. For instance, cryptocurrencies seem to have surged since the conflict started. But for the capital markets, stock markets, fixed income markets, I feel over the next couple of weeks or shortly after the conflict ends, we'll see a reversal in many of the trends that we're seeing now. Typically, it takes about 1 month to about 6 months for Russia's aggression to persist on African markets, and this is data driven, not just speculative. So pretty much we may still see a bit of stocks plummet over the next few weeks as the conflict deepens, but we should all expect there to be a reversal of that trend once the wind of the conflict blows away.
Right, and I saw the market sell-offs yesterday with you know, all the global markets like the Nasdaq, but for some reason the cryptocurrency market stayed up yesterday, and obviously they're banning Russia from SWIFT payments, but it seems cryptocurrencies are coming into play here, using it to send funds in and out of Russia. How do you see this playing out?
I mean, Russia has like a significant cryptocurrencies market. About 12% of the market is controlled by Russia. And even though they initially banned it, they must have had this whole conflict with Ukraine coming, and so there's been a reversal in the past few months on the ban, in a few drafts regulation going on. So typically, you'd expect that with SWIFT's restrictions on the Russian central bank, a number of transactions will be channeled through cryptocurrencies, and the chances of that deepening over the next few weeks with more sanctions and counter sanctions being thrown around, it's a lot higher, and it's a positive for cryptocurrencies. So yes, a market as big as Russia reversing its initial ban and trying to accept cryptocurrency as a currency, just because of payments regulations that they may be subject to over the next few weeks, bodes well for cryptocurrencies. And that's probably like the only asset that I think would gain consistently in the course of this conflict, the only risky asset that may gain consistently in the course of this conflict.
All right, so, you know, talking from an investor perspective now, what would you say is the, you know, perfect portfolio mix, you know, at this point?
I mean, for African countries, cryptocurrency is probably not an option for us from the regulatory perspective. But I think a bit of a portfolio mix that is skewed to equities right now should do the magic. And the reason is valuations, because like before the conflict even started, we're seeing like down movements in stock prices just because treasuries were inching higher. So valuations are pretty cheap in the stock market right now. So it's a good opportunity to snap some really good value stock. So I would expect a portfolio mix skewed in favor of equities, a bit of fixed income, just so that you're also able to take part in some of the gains with the recent treasury yield rises you get. But I think over the medium term, we'll see equities still outperform whatever it is that your treasuries may be giving you at this time.
I know the Monetary Policy Committee will be meeting this month. What do you expect them to, what policies do you expect them to push this time?
Sorry, I didn't get your question.
No, I said the Monetary Policy Committee will be meeting this month. So what are you expecting from the meeting for Nigeria?
I mean, I expect them to still hold. With what we've seen going on in the global space, most central bankers are likely going to err on the side of caution at this point. No one knows how high inflation will go. I mean, for Nigeria, for instance, we've been seeing a deceleration in inflation, and also there are a lot of moving pieces at this time in terms of monetary items. So I would expect the decision at this month's MPC to be a hold, just to get more clarity on a number of things, both in the global and domestic markets.
Right. All right, Moshokbe, everybody. We'll keep tracking as everything plays out. Thank you so much, Moshokbe, everybody. Economist,
Thanks
IC
for having
Group.
me.
It was great having you on Biz this morning. Enjoy the rest of your day.
Thank you.
All right, now, next is AFEX Commodity Update. And for the week ended 28th of February 2022, the AFEX commodity market summary was mostly red, with the number of deals down 9%. Also, volume was down. Well, to bring us up to speed, we have Michael Martin, portfolio manager at AFEX, to give us details. Great to have you, Michael. Good morning.
Hi, Ladi. Good morning.
Good morning.
Always a pleasure to be here.
Always great to have you. So give us a rundown of activities on the exchange.
Thank you very much, Ladi. So if you look at the commodity market summary, the total value of the total turnover of transactions on the exchange in the week under consideration fell by 75.54%, from around 3.89 billion to close to trading week at 0.95 billion. The total number of contracts traded on the exchange also fell by 80.89%, from around 12.27 million contracts to close to trading week at 2.34 million contracts. The total number of deals also fell by 9.81%, like you mentioned earlier, from 540 deals to close to trading week at 487 deals. The AFEX Commodities Index, which is the ACI, also fell slightly by 0.18%, from 481.87 points to close to trading week at 481.02 points. The AFEX Export Index, however, saw a marginal increase of 0.40%, from 194.75 points to close to trading week at 195.52 points. With regards to the volume of contracts traded on the exchange in the week under consideration, we generally saw a decline in comparison to previous week, with the biggest changes happening with maize, which fell from 5.86 million contracts to trade just 575,000 contracts this week. We also saw a big change with soybean, which fell from 4.36 million contracts last week to trade 1.26 million contracts this week. And lastly, with regards to volume, we also saw a big change with paddy rice, which fell from 1.40 million contracts last week to trade just 801 contracts this week. With regards to the price changes on the exchange, the biggest gainers in the week under consideration was sorghum, which went up by 3.26% to close the trading week at 234.96 naira per kilogram. We also saw a big change with cocoa, which went up by 1.74% to close the trading week at 1,272 naira and 20 kobo per kilogram. And lastly, with the biggest gainers, we saw paddy rice, which went up by 1.20% to close the trading week at 230.72 naira per kilogram. And with the biggest losses, we had maize, which fell by 6.3 0.36% to close the trading week at 226.47 naira per kilogram. And lastly, we have soybean, which fell by 1.81% to close the trading week at 401.74 naira per contract. So those are largely some of the biggest changes that we saw on the exchange of the week under consideration. And as we always mention, if you want to know more about the commodities market, you can always download our app, which is available on iOS and also on Android, and you can get started trading commodities.
All right, thanks for that, Michael. But since we're not seeing much price movement with commodities on the exchange, is there any reason for that?
Yes, there is. So around this time period is when you'd ideally see most processors staying away from the market. And that's largely due to the fact that most of them have already taken most of their inventory position at the beginning of the season, usually around the month of November, December, and then maybe even the earlier parts of January. So the month of February and March are where you then see the activities of these processors, who are the biggest buyers in the market, slow down significantly before they then begin to enter the market again, let's say between the Q2, the second quarter and the third quarter of the year.
All right, then. Today it seems the fuel scarcity is still with us. What can we expect for commodity space if, this actually continues?
Not a lot, to be honest, because in terms of direct contribution to the commodity prices, it has very little in terms of a direct correlation. Where we are most likely and have seen changes in recent weeks is with the logistics prices. So we are seeing some of the logistic partners that we have on the exchange charge a higher, amount in terms of having to move those commodities from one place to another. And of course, that has an effect for processors who may or may not need to have those commodities delivered at their preferred location, from time to time. So in terms of direct contribution to the commodity price itself, very little to no effect. But in terms of its contribution to the logistics price, we tend to see a lot of changes in the logistics prices.
Right, and it does have a massive impact on me. I don't have fuel, Michael. I don't know about you, but let's hope it ends soon, though.
It took me a while to get mine yesterday.
I can imagine. All right, Michael, thank you so much. All right, part two of the AFEX commodity update. We see Russia and Ukraine are deeply embedded in the world's agricultural and food markets. Present Ukraine-Russia situation has an influence on prices of crude oil, commodity prices, most especially wheat, and even the financial markets. For analysis now, we have Yusuf, who's going to be head structuring and origination at AFEX, joining us. Great to have you, Yusuf. Good morning.
Good morning, Ladi. Nice to be here again.
Yeah, so could you provide some, context on the magnitude of the probable uptick in global and local grain prices, as a result of this crisis?
Thank you, Ladi. First of all, these are very difficult times, and our sympathies with all the people involved. We pray this doesn't get more serious. It gets de-escalated pretty soon. But then going back to your question, Russia, Ukraine, the entire Black Sea region is very critical to the global agricultural commodities market, very importantly for commodities like wheat and corn, right? So these countries combined contribute almost 25% in the case of wheat, and I think about 17% in the case of corn to the global supply, and they are massive exporters, right? So if you have these supplies taken away from the global market, you can then have a sense of where we are going to in terms of prices. Already prices are about 22% up for corn already in the international commodity, on the international commodity exchanges, and then you also have price of wheat about 29%, if I'm not mistaken. So that tells us where we see this going. And the funny thing is, these two commodities are pretty important, are very important to the lives of a lot of people. They are staple commodities, basically. So you can then think of the ripple effect you can then see across the world. The last time this kind of thing happened, we saw the Arab Spring Revolution come up. So this time around, we hope the governments have enough of inventories to release to complement whatever they're able to import. That's on the agricultural commodities side. Then you then have the case of fertilizer as well. This same region, Russia and Ukraine, they contribute significantly to the what we call the urea and the potash market. And if these commodities, urea and potash, are very critical to what we consume in Nigeria, in the case of NPK 2010-10 and NPK 15-15-15. And what we are beginning to see already, in addition to what we've seen over the year 2021 is that fertilizer prices are going through the roof. The fertilizer index of FAO is already at its all-time highs, and what we see is that by the time these prices are transmitted to countries like Nigeria, farmers will have to bear a bit of the brunt in terms of price changes. So price changes clear. Wheat, corn, and fertilizer are the most impacted commodities in this case.
Yeah, quite an incredible ripple effect there. But you see, wheat prices have risen by more than a fifth since the start of the year to near 10-year highs, while maize prices have risen about, 15%, as you said. But these are the two most consumed grains, in Nigeria. What do you see, happening to local farmers and consumers?
So in the wheat market, you can see a direct relationship between the international market and the domestic market when it comes to wheat, because we barely produce up to 5% of what we consume. So the bulk of it is imported. So wheat is a direct transmission into the Nigerian market. So you see flour millers experiencing higher cost of goods sold, and they would very likely transfer that to the final consumers, which is you and me and you. We buy the bread, we buy the pastries, we buy all the confectionery. So we pay for all of these things eventually. So at the end of the day, the wheat prices would be transmitted almost one-to-one to the domestic market. For corn, however, we still have a bit of a barrier in transmission of prices between the international market and the domestic market. Already the domestic market is on a 4-year high, if I'm not mistaken, and that means that we're already at a very high level. But what we see is that international prices don't really transmit to the domestic prices because of some trade policies that we have in the country, and that might mitigate the transmission of maize prices, the international corn prices to the local market. However, notwithstanding the fact that international prices cannot be transmitted easily to the domestic market, we still think that corn prices in the domestic market will face some pressure going forward. As Michael said earlier, we now have a situation where processors are staying away from the market now. That's why we see the calmness and the decline in activity. But once these processors come back to the market, you see prices continue to move upwards again. So that's just it. Wheat prices can be transmitted one-to-one, but corn prices might face a bit of a challenge being transmitted because of domestic trade policies.
We might have to bump up our own wheat production at this point. But the crisis has also aided further rise in prices of natural gas, the main ingredient of fertilizer. Is this something we should be worried about, ahead of the planting season?
Yeah, I think we should be paying attention to it going into the next production season. Some indicative prices that I hear of about fertilizer in the market is that we might be seeing about at least a 50% rise in the cost of fertilizer going into the next production season. And if you think about how that would affect your cost of production, given the fact that fertilizer might be one of the inputs that contributes the most to production cost, you can then have a sense of where commodity prices will be at the end of the year when we harvest these commodities. So natural gas prices going through the roof almost 6 times in Europe, about 2 or 3 times in some other parts of the world, will also contribute to increased fertilizer costs across the world as well, and including Nigeria. So production costs going into the next production season is expected to be about, for fertilizers, expected to be at least 50% higher, going by what we see in the market. And it's not just peculiar to us, it's across the world.
And if I remember correctly, I know somebody actually predicted some commodity super cycle for 2022. I don't know if that's actually going to happen, but is there any course of action that the government or private sector stakeholders in agriculture should take right now?
Yeah, let me just add a bit of comment to your super cycle narrative. So, to be honest, the super cycle is established. At first, I for one was contesting the argument around the super cycle, given the fact that we had not seen the elements that were required to validate a super cycle argument. But then, as of now, it's fully established. Kudos to the guys that saw it coming. But then we're in a super cycle, clearly. The second thing is that in this kind of instances, there's no other option than for government, private sector players to double down efforts to come into this market and see how they can contribute to solving some of these problems. Already, the federal government of Nigeria is doubling down some efforts in the production of wheat so that we can increase domestic production of wheat and balance that, try to at least balance the deficits that we have. We also need to do some of this for some other commodities like corn, maize, going into the next production season. And for us in AFEX, we've always held this perspective, because we believe there are so many deficits situation across the agricultural value chains, and there's nothing we can do other than contributing our quota to the best of our abilities in advancing these value chains. Already we are partnering with the federal government of Nigeria in producing wheat and in increasing wheat production. The dry season input farming is also, the dry season farming for paddy rice is also ongoing. We have some activities going on there. We are also preparing for the wet season production that will be looking at maize, sorghum, paddy rice, ginger, and all of these commodities. So for us, we all need to put our hands on deck and contribute what we can to this value chain. Otherwise, we already see about excess of 20% food inflation in Nigeria. We might actually be looking at more going into the next harvest season if we don't act now. We still have some window, so I think it's nice for us all to contribute our quota and act now.
Yes, and we do surely hope for peace in the world. Thank you so much, Yusuf Ogunvi, Head Structuring and Origination at AFEX. Thank you so much. Take a moment now. All right, now let's take a look at what happened in the markets yesterday. Anete, how's it looking?
Good morning, Ladi. Happy Wednesday, I would say.
Yep.
Well, for the markets, I'm starting off with the fixed income market. It was quite a mixed bag for that market. And then, of course, for the equities market, it sustained positive sentiment for a second day in the week. Of course, we started a new month in the green. So let's get started with it. This is how it turned out for the bonds market segment. The bonds market was, it ended with bullish sentiment. Of course, we had investors, buying interest for particularly the March 2025 and the April 2029 bonds. Then in total, number of deals carried out there was 7 as at Tuesday's trading session there. Then the highest value was placed on the 23rd of February 2028 paper, which had about $1 billion, placed on it, and in 2 deals. Then flipping over to the Treasury bills market, the average yield there had it increased. Actually, investors were expecting it to decline, but instead it went up. It was a bearish sentiment there. Of course, average yield went up by 1 basis point to 3.6%. So now to give us a much explanation on that market, let's speak to Chioma Udu, who's a fixed income dealer at GT Bank. Thank you for joining us, Chioma.
Good morning, Anita. Thank you for having me.
Yeah. Okay, so now the market, last week we had the FAC disbursement, and then of course we were also expecting 70 billion naira inflows from OMO maturities. So how did the market report, how did it respond to this?
Okay, I'll start by explaining the liquidity, what's happening with the liquidity in the market, then I'll go to the fixed income market. We opened the market about 70 billion. This is basically, like you said, OMO maturity coming into the system. Some types of trickles of tax payments came into the system, about 300 billion, 200 billion, we're not very sure of the amount, came into the system that helped the liquidity in the market. But before the fact came in, like you rightly said, the market was mixed. At the short end of the curve, we saw bearish sentiment because the system came off started up tight. Rate traded around 4% because we saw people trying to discount their bills to be able to, invest and provide liquidity for them. Towards the ending, as fact started coming in, we saw the trading session overturn and then it turned to a bullish bias. Going to the bond, it's sentiment in that space. This is because of the fact there's a tax implication of buying any other assets that is up from federal government fund, and then it's fund payments that we expect is going to come into the system of about 340 billion going to come into the system this month. So we've seen investors and traders trying to take position, long positions to take advantage of all the liquidity we expect to come into the system.
Okay, so now, do you expect investors to sustain their buying, their buying of bonds or the fixed income market, the fixed income instruments, or what's your expectation for investors for the rest of the week?
Well, my expectation is that we're going to continue to see the bullish trend on the long end of the curve, that is the bonds. The sentiments are back coming into the system. Coupon payments of about 340 billion is expected in the system. And then the tax implication on investment, it doesn't affect bonds. So we see a lot of interest in that space.
Okay, so thank you for that analysis, Choma. And then, of course, we always will keep an eye on that market. So that was Choma Udu, fixed income dealer at GT Bank. So moving over from that market to the stock market, it gained more than 47 billion naira at the close of Tuesday's trading session. Of course, that gain, it came in the midst of some profit-taking across the market. We had about 15 gainers in contrast to 31 losers. But of course, this gain that you saw in the market is 0.19% gain, which is the month-to-date gain so far, was led by the likes of Seplat, MTN Nigeria, GTCO, and Access. So that's what lifted the market by this margin. But when you take a look at the sectoral performance, you can see there the impact of Access Bank and GTCO wasn't felt much. That counter fell by 0.75%, while the oil and gas, of course, Seplat, had much impact on it. It was up by 5.36%, quite a large margin for that counter there. So in terms of the activity carried out on that market, it's still in the green. We had more than 6,000 deals carried out there, and the total value, in contrast to the previous session, that's on Monday's session, was 7.85 billion naira, and the volume of transactions was more than 370 million units of shares traded by investors. So it tells you that, yeah, investors are really keying into the market. Particularly, yesterday we also had a flurry of earnings. We had the likes of Dangote Cement, we had Adova, we had Lafarge, we had Seplat, and we also had NASCON releasing their earnings results. So, of course, we will be looking out for how the market reacts to some of this earnings report. Sometimes the market may react, sometimes it may not, but of course we definitely will keep our eyes out for how the market turns out at the close of midweek trading session later today. So then for the unlisted securities market, it's still going down. The close of Tuesday's trading session, it was down by more than 0.5%, 0.56% at 725.85. That's the index figure for the unlisted securities market, while the market cap, it's dropped to about 614.63 billion naira. Then in terms of the volume, value, and deals, it's all not too impressive. So that's all for the market. We definitely will continue to keep our eyes out for how the market turns out at the close of midweek trading session. Back to you, Ladi.
All right, Nita, thanks for the update. We'll see how investors react to most of these earnings. All right, we'll take a quick break now. We'll come back. We head to London. That's in a moment. Just stay with us. All right, let's look at what's happening in the crypto market before we head to London. There we see, let's take a look at what's happening with Fear Greed Index this morning. I would see it's at 52 points over 100. That's neutral. It shows that the market is not afraid at this point. It's not fear, it's not extreme fear, it's neutral, but it's not greed yet, but it could be heading to greed at this point. Market cap at this morning, we see $1.94 trillion, trying to edge back above the $2 trillion mark. It's up 1.63%. Volume traded in the total crypto space, $109.79 billion. It's down about 1.45%, and we see Bitcoin dominance still ranging up there at 43.11%. Let's look at the price of Bitcoin ATM, $43,914. It's up by 1.16%. We see the market there with Bitcoin spike there, trying to test that 45,000 resistance against the US dollar. Hasn't been able to get there and break it yet, but we see the bulls trying hard to get it above $45,000. Okay, Ethereum now, $2,967, so up by 1.68% this morning. Volume traded in Ethereum, $19.10 billion. All right, let's bring in Gilbert Okwata now, digital market analyst. Hello, Gilbert. Good morning.
Yeah, good morning, Mr. Ladi.
Yeah, great to have you, Gilbert. And I'm sure you're smiling because market is looking good today. But anyway, I see on-chain analysis from Glassnode shows investors are hodling, aka holding, for future gains instead of selling, despite war tension. Why is this happening?
All right, when people think the world wants to end or in time of crisis, they always buy gold. But Bitcoin is the online, borderless, and more limited version of gold, which exists out of the traditional market. We have also seen while banks in Ukraine are not being able to function, they have turned to the use of Bitcoin. We have also seen where massive donations are being sent through Bitcoin and other cryptocurrencies. So there is high demand. And what is happening fundamentally is just a fundamental pricing in. The market presently is highly driven by fundamentals, which also shows stronger hands have dominated the market. But that Glassnode chart actually showed three interesting things. One was an illiquid supply, which shows that about 76% of coins are in wallets with no history of spending, and there is consistent dollar cost averaging taking place. It also shows a hodling wave of about 72% of Bitcoin is being held by people who have not moved their Bitcoin in the past 3 months or more. And this is crossing the border from short-term hodlers to long-term hodlers. The last chart was that of a stronger hand that shows that this coin crossing the 3 months hodling are actually being moved to exchanges, moved from exchanges to cold storage. And this is likely to continue with macroeconomic tension and what is happening in the global scene right now. We are likely going to see more institutions get in and more retail investors coming with a long-term perspective into the market. The market is no longer a baby anymore. It's not quite strong.
Quite interesting. Quite interesting. And, talking about, how easy it is to move cryptocurrency, you could practically put $1 million into a flash drive and actually cross over to another country. I guess that's one other attraction with Bitcoin there. But let's look at price. Now, any possibility of further downside?
Okay, we have always wished for institutional involvement in the market to come pump our bag. But right now we have Wall Street present in the market. But we need to understand these people have a script they play. The present market structure is not that of a typical bottoming. After there is always a marginal breakout after a major sell-off, we always see a marginal lower low before it gets hammered out and an uptrend begins. But the present market structure have a technical problem. It just held itself and is grinding all the way up. We can probably even see the market go test 45, 47, but a downside risk isn't eliminated yet. There is a possible phase out and a weakening. We go test back a little bottom before we could form a stronger base for a takeoff.
All right, and I remember when oil was trading around $80 per barrel, and I was wondering what could take oil over $100, and this happened. But the $100,000, is it still on the cards for Bitcoin?
Yes, it is. We are not out of. We are still in a macro bull market. Yes, we may be going through a bear phase, but we are still through a macro bull market. $100,000 is not phased out yet. We still have possibilities of seeing that sooner than we probably think.
Right, right. All right, Gilbert, always great to talk to you. Thank you so much. All right, now let's take a look at what's happening in London. I guess we have Juliana now. Great to have you, Juliana. Good morning. Well, I see Brent crude oil price blasted past $111 a barrel.
I'm things in my ear, so apologize.
Can you hear me? Can you hear me, Juliana? Hello, Juliana.
I can hear you. Let's talk very quickly before the show wraps about Brent crude, as you were saying,
So,
trading above $100 a barrel. How does this affect consumers in the UK? Well, it's petrol prices, really. We've already heard from motoring groups such as the RAC and the AA. They have warned that we could see petrol reaching up to £1.60, in fact, even £1.70 per litre. And this is whether or not you're driving a petrol or a diesel car. Currently, it's at about £1.55 per litre. So if you are driving an average family car, it's going to cost you about £85 to fill up your car. This is all because of what's happening on the 7th day of the Russian invasion of Ukraine. There have been some calls, particularly from the opposition Labour Party, asking Chancellor Rishi Sunak to try and reduce fuel duty or VAT on petrol prices, which I believe has been frozen for about 12 years now.
And we see our retail price annual inflation accelerated to about 1.8% in February, up from 1.5% in January. That's the highest, rate since November. Not looking good there.
No, it's not looking good. And I think, as consumers are seeing and facing crippling inflation, so are retailers. They've got labour shortage issues, higher commodity prices, higher supply chain costs. And this is starting to trickle down on consumers. We've seen this with the month-on-month growth. I think the biggest upward push has come from food prices, particularly fresh food prices. So if you're somebody that likes to eat fresh food in the UK, you will start seeing that your cucumber and carrots are costing you far more. But then also we are starting to see in furniture and in beauty products that prices are increasing. So it's not a great time really here in the UK. And unfortunately, it doesn't look like it's going to get any better anytime soon. We've had the warnings from the Bank of England that inflation is going to significantly rise way into the spring, currently running at about 5.4%, likely to run by about 7.5%. And you have to add in all of the other issues that we've got, such as the national insurance tax, which will rise in April, the energy price cap, which will again rise in April, and these higher fuel prices, which we've just been discussing. Not great time.
Right, and I hear stagflation is being thrown around now at this point. All right, Juliana, thank you so much for the update.
Thank you.
All right, so that's a wrap on the program. Thank you so much for watching. Don't forget to join us at 1:30 on Business Incorporated for more updates and developments in the world of business. Thank you so much for watching. I'm Ladi Williams. Bye-bye.